Okay, good evening. We are looking at cost classification, all right, um, in FMA, management accounting. So, cost classification and cost behavior, all right. So, we are now getting down to the understanding how costs behave in fundamental to management accounting. Costs are not all alike, they respond differently to changes in business activity. This section explores how to classify costs and predict their behavior. So we look at the classification by function. Before examining behavior, it's useful to understand how costs are classified by their function. So we have the production costs, these are manufacturing costs, the direct materials, the raw materials that become part of the finished product, wood for furniture and steel for cars, the indirect labor, wages paid to workers who directly transform materials into finished products, assembly line workers, and of course, machine operators, direct labor cost, in manufacturing overhead or other production costs. We are talking about the factory rent, okay, and of course, the supervisor salaries, as well as the maintenance, the depreciation of factory equipment. These ones represent a manufacturing overhead. In the non-production costs, we are talking about selling and distribution under the non-production costs. All right, and of course, the selling and distribution cost, the marketing, sales commission, the delivery expenses, and we have the administrative cost, executive salaries, office rent, and accounting department. So now, when we look at classification by behavior, cost behavior refers to how costs change as the level of business activity changes. This is the most critical classification for decision making. So we have what we call the variable costs. Okay, so definition, costs that change in the direct proportion to changes in activity level. Okay, so we have the total cost increases or decreases with activity. Of course, the unit remains constant. And of course, we can now look at what we call a total cost function. So our total cost of every business is equal to total fixed cost, okay, and plus the total variable cost. So this is on the total cost of every business, right? So we have the total cost is equal to total fixed cost. So TFC is equal to total fixed cost. We have total fixed cost. So this is the total fixed cost. And then we have the other one, which is called the total variable cost. Okay, so the other one is total variable cost, TVC, total variable cost. All right, so this is on the aspect of the total variable cost and total fixed cost. Okay, so we Now get down to the example. Raw materials, more units produced, more material consumed. Direct labor is paid per unit, price rate wages. Okay, so now we have the aspect of the fixed cost. Okay, so we are simply saying fixed costs, that costs that remain constant in total, regardless of changes in activity within the relevant range. So cost does not change with activity, it remains constant. Cost per unit decreases as activity increases. Okay, then we have examples of factory rate, insurance premium, salaries, and whatnot. Now we look at now the okay the aspect of the graphic representation. Okay, so the graphic representation on a linearity because the total cost is equal to total fixed cost plus total variable cost. So we are now just simply saying that the total fixed cost, the horizontal line at the fixed cost amount, fixed cost per unit declining curve as activity increases. We have the semi-variable cost now, cost containing both fixed and variable cost. Characteristics, they have a fixed base amount and the plus variable component that changes with activity. Okay, most common type of cost in practice. All right, so we are looking at the telephone expense is a fixed in line rental plus a variable usage rate. So analyzing the semi-variable cost now. Okay, so semi-variable cost analysis. To use the semi-variable cost in decision making, we must separate them into fixed and variable components. So we look at the method one, which is the high-low method. So the high-low method, how it is calculated. This simple technique uses only two data points, the highest and the lowest activity level. So this is what is important. The steps identify the period with the highest activity as number one and its cost. So identify the period with the highest and the highest activity and its cost. Then identify the period with the lowest activity and its cost. Then calculate the variable cost per unit, then calculate the fixed cost. All right, so how do we go about this? We're going to have this example here. So the formula involved the variable cost per unit is cost at highest level minus cost at lowest level divided by activity at high activity units minus lowest activity units. So our fixed cost is equal to total cost at the highest activity minus variable cost multiplied by high activity units. Okay, variable cost multiplied by high activity units. All right, so this is how you get to the high-low method. The high-low method, this is the formula here. Variable cost per unit is equal to cost at high activity minus cost at low activity over high activity units divided by low activity units. Then our fixed cost will be total cost at high activity and minus variable cost per unit multiplied by high activity units. So this is about how you get to the fixed cost calculation. So using this example here, you can see what is happening. From this example, we are calculating the variable cost per unit. We look at the cost at a high activity level. We have 22,000. Okay, and cost at low activity level. Cost at low activity level. So high activity level, the cost at low activity level. So the cost at high activity level is 2,000. the cost is that much. At low activity level, 1,000, the cost is this much. Okay? So you find the difference, the cost at highest activity level, which is $22,000 minus $15,000. Then we divide by the difference between the highest activity level and the lowest activity level, which is giving us $7,000 divided by 1,000 units, which is giving us $7 per unit. This is a variable cost per unit. Okay, so variable cost is this what we have. So to get the fixed cost now, because we know that our total cost is equal to total fixed cost, so total fixed cost, then plus the total variable cost. So our total cost in this case will give us, we have the 22,000 here, okay? The 22,000 will say now, you do what you need to do now here. It will be 22,000, okay? Which is equal to total fixed cost is X plus the total variable cost. So it will be actually 7, okay? So the formula is here. Okay, it will be variable cost multiplied by activity units. Okay, so 2 multiplied by activity units is 2,000 here. All right, so this is how you get to calculate the X. So X will give us 22,000, all right, minus 14,000. Okay, this is giving us what? 22 minus 14. Okay, so the fixed cost is giving us 8,000 in this case. Okay, so that is our fixed cost. So 8,000 is our fixed cost in this case. Right, so this is how you get the fixed cost and the variable cost per unit. So variable cost per unit, as I emphasize, is a cost at high activity minus the cost at low activity. Then you subtract the high activity units minus low activity units for you to get the appropriate variable cost per unit and fixed cost. So verification for January aspect of the cost. Okay, total cost is equal to the fixed cost plus total variable cost. So total fixed cost and total variable cost here, you're getting a 15,000, which is given there. So for each month, this is how you can get using the high low method of analyzing the cost of the variable cost per unit and the total fixed cost. All right, this is about what we have. So the limitation of high low level uses only 2 data points and ignores all others. All right, that's a limitation. It uses only 2 data points and ignores others, which is a limitation. Like in this case, it will just use the highest and the low cost, ignoring other parameters. Then it assumes linearity. It assumes a linear equation like this is a linear equation as an aspect where we are looking at the linearity, where we simply say we have this arrangement and this is our total fixed cost. Okay, and it goes like that. This is our point. Okay, so total fixed cost. Okay, then total variable cost. Okay, so the variable cost will vary with production. Okay. All right. So that's what we have. So we have that one there. Okay. So now as we come to this one, we are now saying sensitive to outliers. That's another limitation of Euler method level. Okay. So that's another one. So we have assumes linearity. Sensitive outliers uses only two data points. Okay, so now we get into what we call method two, which is the scatter graph method. Steps involved are that plot all data points on a graph, activate x-axis and cost on the y-axis. Draw a line of best fit visually, where the line crosses the y-axis is a fixed cost. All right, and then calculate the slope for the variable cost per unit. Advantage is that uses all data points, and advantage subjective, depends on judgment. The method three we are looking at is on the least square regression line, which uses the slope and the intercept as this one. So our total cost is y, our fixed cost is a, our variable cost is the slope, and next is the activity level. So the advantages are that it's most accurate and objective. Disadvantages and this one requires to discuss software or calculator. Okay, then we can now look at the practical application. Understanding cost behavior enables cost forecasting, predicting costs at different levels of activity, price and decision, setting prices that cover all costs, performance evaluation assesses or the cost control effectiveness. The solution also using for budgeting, creating realistic budgets and for decision making, make up or buy or accept special orders. Then we will look at what we call the break-even point analysis. Okay, so understanding cost volume profit relationship. Break-even analysis, also called the cost volume profit CVP analysis, studies the relationship between cost, sales volume, and profit. It answers critical questions that how many units must we sell to break even, and what profit will we earn at different sales level. The key concepts and terminologies is contribution margin. So this is where we are simply saying that our break-even point is the point at which the firm should sell units of a commodity. All right, and the formula for break-even point is equal to, okay, so our break-even point is equal to fixed cost. Okay, so we have the fixed cost over selling price per unit, then of course minus the variable cost per unit. This is how we get to our break-even point. All right, so the concept and terminology, the contribution margin is a foundation of break-even analysis. It represents amount remaining from sales revenue after variable costs are deducted. So our contribution per unit is equal to sales minus variable cost, which is just the sales, okay, minus variable cost of sales, variable cost of sales. So this is how you get what we call contribution. All right, so CPU is simply means contribution per unit. So you don't necessarily worry about it. So contribution margin, the formulas that are involved here, contribution margin per unit is selling price per unit minus variable cost per unit. That's how you find the contribution. That's the first one. So anything else to get contribution, you just use the selling price per unit minus the variable cost per unit. Okay. Then, of course, we have other formulas. So total contribution margin is equal to total sales revenue minus total variable costs. That's another aspect of total contribution margin. Okay, so total contribution margin, total sales minus total variable cost. Then we have the contribution margin ratio is equal to contribution margin per unit over selling price per unit. So contribution margin per unit over selling price per unit. So this is how you get the contribution margin ratio. And of course, contribution margin ratio tells us a story about the percentage of each sales dollar in value that is variable or valuable to cover the fixed cost and provide profit. All right, so these formulas are very, very important for you to know as we are looking at the break-even point. Formula is that one there. And of course, we now getting down to the break-even point analysis in detail. So break-even point is just a level of sales at which total revenue equals to total cost. So there is no profit at this point. There's no profit, no loss. So break-even point in units or fixed cost or contribution margin per unit, which is this one at the bottom is called the contribution margin. This one here is what we call the CPU, contribution per unit. So in other words, we are simply saying that the break-even point is a point at which our total revenue equals to total cost. So what we are simply saying is that we have no profit in this case. There is also no loss. So no profit, and then of course we have no loss. This is how we are getting down to the break-even point. So now our BEP, okay, so we are getting down to BEP. BEP, we are simply saying BEP is equal to fixed cost over selling price per unit. Okay, so in short, we just say over CPU. Over CPU. CPU is a contribution per unit. That's the formula. Or the denominator at the break-even point is the CPU is where the selling price per unit minus variable cost per unit. So BEP is equal to, okay, fixed cost over selling price minus variable cost per unit. So selling price is per unit minus the variable cost per unit. This is how so this one here is called the contribution per unit. CPU. Contribution per unit. All right, so we can move on, okay, and check what is happening here. So our breaking point in units is fixed cost or contribution per unit. Then breaking point in sales is fixed cost or contribution margin ratio. Okay, contribution margin ratio. Okay, which is the contribution margin ratio is equal to contribution per unit over selling price per unit. So let's help find a breaking point in sales. Now, the margin of safety, MOS. So these are units of commodity that we actually look at. Okay, so margin of safety, these are units of the commodity that we produce above the break-even point in order to achieve a profit. So the margin of safety measures the buffer between actual and expected sales and the break-even point, all right? Indicates how much sales can fall before the company starts losing money. So margin of safety in units got actual sales minus the break-even point. So it's Q minus BEP. This is how you get the margin of safety, all right? It's Q minus BEP. So what we are trying to say here is that a margin of safety in value is actual sales minus break-even point sales. Okay, that is margin of safety in value. Actual sales minus break-even sales revenue. All right, margin of safety ratio is margin of safety over sales times 100%. It's margin of safety over sales multiplied by, so it's actually Q minus BEP over Q. Okay, so when you look at our margin of safety, so our margin of safety is equal to Q minus BEP, then over Q multiplied by 100%. Right, so this is how we get what we call margin of what? Margin of safety. All right, so from here, we are getting somewhere. So a high margin of safety indicates how risk. A low margin of safety suggests a vulnerability to sales as to sales declines. In target profit analysis, we are simply looking at the break-even point. Analysis can be extended to determine the sales needed to achieve a target profit. So sales for a target profit is fixed cost plus target profit over contribution margin per unit. So fixed cost plus target profit, then you divide this one by contribution margin per unit. So sales for target profit will be fixed cost plus profit over contribution margin ratio. We can either use this one or this one. So we can wrap up as we look at the comprehensive example on the CVP analysis. ABC manufacturing process widgets with the following information. Selling price is 50. Variable cost is actually 30. So meaning as we get our CPU contribution per unit will be equal to what? Selling price per unit, right? I don't know. Are you following so far? Are you getting me? Okay, so we are going to have the selling price per unit minus the variable cost per unit. So SP, okay, per unit, then minus the variable cost per unit. So this is how you get the CPU. So fixed cost is 40,000. The current monthly sales is 25. So the contribution margin is $20. Selling price per unit minus variable cost per unit. Then of course, contribution margin ratio is 20 over sales times 100% is 40%. All right, so it's 20 over 50 selling price times 100 is 40%. This is how you get the contribution margin ratio. Then the break-even point is fixed cost over CPU. Okay, CPU, which is the fixed cost over contribution per unit. That's the formula which I give here, considering the break-even point in units is fixed cost over contribution per unit. So we are actually getting the value, okay, which is giving us break-even point in units is 2,000. Break-even point in sales units is fixed cost over the contribution margin ratio 0.4, which is 100,000. Okay, 100,000. Okay, so it's as good as saying break-even point in value. So you can even say it can also be 22,000 multiplied by 50, which is 100,000. Okay, so this is the selling price per unit. The break-even units were 2,000 units divided by 50. All right, so this is what happens here on this example. then you can get the margin of safety in units is Q minus BEP. MOS, all right, is equal to just Q minus, okay, so MOS, okay, is equal to Q minus BEP. So Q minus the BEP. So this is what we have. Q minus the BEP. So these are units that they say they are selling 2,500 minus actually, okay, BEP. So it is giving us margin of safety in units is 500 units. In margin of safety in percentage, okay, margin of safety in value is just actually the 2,500 multiplied by the selling price. Okay, so our margin of safety in value, we simply said margin of safety is after sales revenue minus break-even sales revenue. So our break-even sales revenue, so here we are simply saying Q is 25 times 50 minus the 100,000 as the breaking point in value. So our margin of safety is 25,000, right? Or the ratio is the margin of safety will be this one over Q multiplied by 100% to find margin of safety in percentage. So what are we simply saying? Our margin of safety is 20%. So sales can fall by 20% before company incurs a loss. So sales can fall by 20% before the company can incur even loss. All right, so target profit. Suppose management wants a monthly profit of $10,000. So we can now use the unit sold to achieve a target profit. It's fixed cost plus target profit over contribution margin per unit. Okay, so we're simply saying, suppose the company wants a target profit 10,000, meaning that we are going to just use the formula that we simply say it is the, okay, fixed cost was 40,000 plus a target profit of 10,000 over the value that we found as contribution per unit over 20. So this one is giving us 25. Okay, so the required sales revenue, okay, units will be sold to require to achieve a profit. So required units will be 2,500 and the required sales value will be equal to this amount, 125,000. All right, so the break-even chart, we are simply saying that the break-even chart provides a visual representation of cost volume profit relationship. It helps managers understand the dynamics at glance. In constructing a break-even chart, set up the axis, the horizontal x-axis that is for output and the y-axis for the cost and revenue aspect. Drawing the fixed cost line, horizontal line at the level of the fixed cost and parallel to the x-axis. All right, then you draw the total cost line, start at the fixed cost line on the y-axis, then slope upwards at the variable cost. Then you also draw the revenue line and the key points that are supposed to be there. So the assumptions now of the assumption and limitations of the break-even analysis. What are the assumptions and limitations? So the first assumption here is that okay, linearity. All costs and revenue functions are linear throughout the relevant range. We have the constant selling price. Price does not change with volume. Constant variable cost, the unit remains constant. Fixed cost also remains the same. And then single product. Okay, and for more product campaigns, the production equals sales, no inventory changes, and there are some other assumptions that all whatever has been produced is sold. So these are the key assumptions of the break-even analysis. All right, then we're looking at the time value of money ignored. Okay, so the time value of money is ignored, all flow occur in the same period. And the limitations now are that the first one, we are looking at the specification. Real world relationships are rarely perfectly linear. And then you have the relevant range analysis valid only within the relevant range. And then the static analysis provides a snapshot, not a dynamic view. Okay, so applications beyond break-even point now. Okay, so break-even analysis supports numerous management decisions. It also looks at the price decisions. What price must we charge to break even at a given volume? And of course, make up or buy decision. At what volume is it cheaper to make or rather than buy? So break-even point, make fixed costs or stroke buy cost per unit minus variable cost per unit. All right, then also the special order decisions. We are looking at we are accepting a special order at a lower price, increase profit, then the cost structure decision. Should we automate higher fixed, lower variable, or remain lower intensive or lower fixed? So this is on a break-even point. This is just now to make just a recap on whatever we have done. We've looked at the break-even analysis in this concept with this slide. We have also now looked at how we calculate the method highs, analyzing semi-variable costs. We are looking at method one on high-low method, where we looked at how to identify the period with high activity and its cost. And of course, identify the period with lowest activity and its cost, and calculate the variable cost per unit and the fixed cost per unit. And the formula that we use to calculate the variable cost per unit is cost at high activity minus cost at low activity, where we also divided the high activity minus the low activity. Okay, so we identifying the cost at high activity, which is high activity is 2,000 units, the cost is 22,000. And of course, the lowest activity is 1,000, the cost is 15,000. So getting the variable cost per unit, subtract the cost at high minus cost at low, subtract the difference between the high units, 2,000 minus 1,000, give us the $7 per unit as the variable cost per unit. Now, finding the fixed cost, using the formula, we said our total cost is equal to total fixed cost, okay, plus the total variable cost. Then we are trying to just solve for our fixed cost using this equation. So using the equation, okay, for the fixed cost, we found 8,000, substituting using the 22,000 as total cost minus the variable cost of 7 multiplied by 2,000, right? Then we're getting 8,000 as the fixed cost using this expression. And of course, verifying for the month of January, we multiplied 7 multiplied by 1,000, then plus fixed cost gave us a total cost of 15,000 using this formula. And of course, the limitations of high-low method, it only uses two data points and it also assumes linearity. Also, it's sensitive to outliers. All right, so this is where we end on the application of break-even analysis, what the contribution margin per unit means, what the total margin and margin ratio, getting down to the break-even point in units formula and breaking point in sales volume, and of course, the margin of safety formula, and of course, margin of safety in percentage, as well as the units to be sold to achieve a target profit. Okay, so we have the fixed cost plus profit over the contribution margin per unit. And these are the ones that we got looking at this example. So we end here for now. Unless there are questions. You have a question? Okay, so if there are no questions, we can end here for now.